I'll get started. I guess the modus of this space will likely be that I'm going to just introduce the concept a bit. Share the article, just what I did, and I'm gonna open the space right away from for people to um, come on stage and have questions, and so we'll move in small stages for this one. So with that on the screen, I'm gonna share the article. So the idea behind this is generic. The article is titled "When to Stop Trading a Strategy." We often see, when you try and search for an answer to such a question, you'll see, a common heuristic being used that if your strategy hits twice the drawdown of your historical backtest, then it's a good point to stop trading that strategy. And what I tried to do here was to kind of walk through an approach which is generic in nature, which is driven by Monte Carlo analysis. And then we took some example. I took some example of a very popular 920 straddle strategy, and then I walked through how to manage that. Okay, so with that said, if anybody has any initial questions, I'm gonna just allow a couple of people to get started, just to see if there are questions. So I have a few requests. I'm gonna allow. Let me see. How do I manage this? Okay, request. Okay, so I'm gonna allow Himanshu first. I'm not sure if you have a question, Himanshu, but oh, yeah, Himanshu, if you can, if you want to speak, please go ahead. Anybody else who wants to speak right at the front can come in and speak. Otherwise, we'll go on. Himanshu? Is it me? I don't know. I can't hear him. So I'm just going to assume that um he's not going to be removed from. Okay. All right. Okay. So I'll move forward. Okay. So let me get started. So so in the article, when I if you have the article in front of you, or if you go to my timeline, you can read that article, set it up in front of you. I start by introducing what a back test is, which is not a it's which is something very standard for a lot of people who are connected to me around on the on the Twitter space. Twitter space or Twitter following, people who follow me or who I follow. So, for others who might be getting started for the first time, the article gives a very initial introduction of a backtest is. Um, Essentially, what it does, if I want to explain it here quickly, what a backtest is trying to do is, let's say you have a few set of rules that you want to test how they would behave in the market, or what you expect the market to react to, or probably provide you a positive PNL. And those rules, you think you want to trade those rules. So for example, let's say a moving average crossover, or let's say a RSI and moving average crossover goes above this or that level, then you want to buy versus you want to sell. So a backtesting framework allows you, what it allows you to do is set your rules on the historical data and see how would it have performed on your historical data. You can always change the parameters of your rules. So, for example, you can change the moving average period, RSI period, look back, crossovers, whatever you want to do. And the output of a backtesting report is generally output of a backtesting exercise is generally a report which has um, equity curve, P&L. So, profit and loss of individual trades, profit and loss of aggregated trades, accumulative equity curve, maximum drawdown, some risk metrics, sharp ratios, so Tino ratios, Kalmar, compounded annual rate, return, so CAGR, and so on and so forth. So there were quite a few things which can come out of a back test, and I don't want to spend more time on that. Essentially, my article also just introduces that in a very brief fashion. again, that you can you can see on the screen right now if you are on the YouTube, or if you go back to the article, you'll be able to see that introduction. Essentially, one of the couple of most important or most looked metrics in a back test are the maximum drawdown and the sharp ratio. So maximum drawdown is worst situation, peak to trough drawdown. So for example, let's say you started with 1 lakh rupees or $10,000, whatever your denominated currency might be, and let's say you make 20% return. So let's say you 1 lakh grows to 1 lakh 20,000. So now you have a 1 lakh 20,000 as the high equity curve or high watermark. Now from there, let's say you lose 5,000 rupees, so you come back to 115, 115,000 or 1 lakh 15,000 rupees. Um, and then let's say your strategy recovers, and then you make a new equity high of 140 or 1,40,000. So essentially, this drop from 120 to 115 is 5,000 rupees, or 5% of your equity or starting equity is your drawdown. And this can happen many times in the space of your backtest, once, twice, 10 times. And essentially, a maximum backtest, a maximum drawdown is the worst situation of this drop in the premises in your historical period, and that's what backtest gives you. It gives you that maximum drawdown, which people look at a lot as a tolerance for pain. How much money can you lose before you start making money, or how much money in the backtest you lost. um, and then sharp ratio is another ratio. Again, I won't go much into deeper into that, but essentially it's the your returns divided by the volatility of returns. Somebody actually DM'd me a while ago, today itself actually, asking what kind of risk-free returns you should use for a sharp ratio, or some constraints. So the only thing I would like to say is sharp ratio by definition is you take the total return of your portfolio on an annual basis. If you're looking at an annual sharp, you subtract the risk-free return, or a return that you might have been able to generate without taking any risk. So for your Indian markets, that's fixed deposits, or for US markets, it's T bonds, T bills, whatever you want to call it, and divided by the volatility of the returns. So usually one consideration is, which your backtest can again customize, is what kind of risk-free returns you use. Um, One point of view that I have also had, and it's in the literature as well, that so sharp ratio was developed for a portfolio. In a portfolio which can hold, let's say, equity, cash, and bonds as well. And usually, typically, what happens is, if a strategy is investing only a portion of their capital in equities and rest is usually in bonds, they tend to match the risk-free returns by putting it in bonds. So in our situation, the kind of trading strategies we run, we use completely risk capital, leverage capital, in which we don't have any allocation to bonds or risk-free assets. So essentially, for us, if we don't use that, uh, so yeah, for the sharp portfolios, sharp was developed for a portfolio. If you are using it for let's say, a leverage portfolio, leverage trading, you can easily use a risk-free rate of zero, essentially assuming that whole of your capital is parked in a futures account, which will not really generate a return. But that's contentious as well, and probably a topic for another day. So I'll move on. Essentially, in the article, so that's what the article introduces: some backtesting introduction, what a backtest is, how do you go from backtest to live. So a typical path that somebody takes is, you have some rules, you tested them out, you have some data, you coded, let's say, in Python, in Ami Broker, TradingView, R, MATLAB. There are so many platforms you can use. And then you go live with it. You essentially study, you say, the results that you see in your backtest, you like it. And then you go on and say, okay, I'm going to start putting live money on this, and you start trading it. Now, you might have often heard that your live results, and some of you might have experienced this as well, that your live results do not match the back test. And one of the reasons is also that in a back test, appropriate cost considerations or appropriate assumptions have not been made. But outside that, it's also realistic to not have the same set of output returns or the live returns as your back test is, because at the end of the day, markets are evolving. The effects that you started trading on may change, may evolve. More people might start trading it. So there are many moving parts which affects our trading strategy, and that's why often you will see your live results are not absolutely or exactly matching your backtest results. So there's a lot of, in research environment, systematic trading research, backtest should be seen as a tool, as one of the features, but not the only research methodology. And again, that's a whole lot of different topics to discuss on. I don't want to spend more time on backtesting, but so with that, armed with that knowledge, then our question, what we really want to answer is, when do we know, or how do we decide that our strategy has lost its edge? Because you'll see in future, like I said, in your trading, when you start live trading, let's say your back tested result shows a maximum drawdown of 10%, and then you hit the 10% in the first 2 days. What do? Because it's very unlikely that whatever you tested out last 2 days ago has dramatically changed within the first 2 days. If you really had an edge, or if you really had an underlying effect that you wanted to harness, then it's unlikely that that will change right away in the first 2 days. So what do you do? What's your reaction? How do you cater to that? So that's the kind of question that I wanted to answer, and I'll be honest about it. What prompted me to do this? I have a suite of strategies which run on Decibel Capital, and which is also on my website. And then some of them, I track the performance in a lot of ways, and some of these strategies hit a drawdown phase, which was after a really long time. So I had some very loose framework built with me, and I kind of started formalizing it, and that's what got me interested in looking into the 920 straddle, which is, by the way, one of the most popular, hated, loved, whatever you want to call it, strategy of the Indian FinTwit. So I thought I'll do some analysis on that and see what the outcome might be, and that's where we are. Um, with that said, I want to just have a quick pause and see if there are any questions on this, or if anybody wants to. I have requests here. I'm just gonna ask. I'm gonna allow people to come up and ask question if they have. So, Hari Babu, I'm gonna allow you to speak. If anybody else has any question that I can answer before we move on, I'll be here. It'll be good. Hari, can you hear me? If you have a question, please. Hello.
Okay, okay, it's okay.
Um, I okay. I'm not sure if Hari wants to speak right now. So, all right. I'm going to move on then. In that case, I'm just gonna. Okay. Okay. So, continuing further, then. So 920 Straddle. Okay, I have another request. Let me see. I just want to ensure that people get the answer. Okay, Nikesh. If you want to speak, Nikesh, you can go next. Okay, I can't see Nikesh. Okay.
Ankit, can you hear me?
Yes, so I can hear you. I hope others can hear you as well, Nikesh.
Okay. So my question is, I saw your paper in detail, and I was little curious whether it would be ever be conclusive, or we can reach conclusion to a certain extent that the subject strategy is no more usable, or is no, because it can happen. There is a long drawdown period, or long periods when the strategy is not working, and it start working after that period. So can we reach to any conclusion at any point of time with all this stuff?
Yeah, so that's a good question, and we'll probably address that towards the end. But for others, who might not have heard this properly, the question is that can we ever get to a conclusion that whatever strategy or whatever work that we have done, through this analysis, gives a conclusive answer that this thing is not working anymore. So, this framework that we are talking today is one of the potential frameworks that can be executed, and it will honestly not give you, a very confirmed answer, but then it does allow you to give use one way of analyzing the methodology, really. So we'll talk about it, once I introduce the framework, for people who probably had a few questions on the framework itself, and then we'll address that question. So
Fine,
thanks for that
fine.
for now.
Thanks.
Deepak, do you want to speak next?
Sure, Ankit. I don't have any questions. I just want you to know. I think some people are waiting on YouTube, and YouTube is not working. It's still saying
Oh,
waiting.
YouTube is not working. Sorry, guys. Let me check that. Um. Okay. Let me. Yeah. Thanks for that. Let me see. I think I had started that. Let me see. Guys, please don't mind holding. You know what? I think in the favor of keeping it simple for everybody, I'm just gonna leave out the YouTube functionality for now and see if I can continue on the. I can always upload this video or recording if somebody else is there. So I'm gonna just give me a second. Why is it not starting? Please bear with me just a minute or so. I thought I had started this. It says. Okay, so I'm gonna stop the live stream on YouTube. Unfortunately, it seems the integration did not go through. So I'm just gonna continue on the Twitter space itself, and hopefully, we'll be able to upload some of the recordings here as well. Sorry, guys. Okay, so we have one more requested speaker option. What's his name? Rohit. Rohit, do you want to speak? You have a question? Okay, doesn't seem to be the case. And then we have Darshan. Darshan, do you want to? Oh, okay,
Hello.
Rohit is there. Rohit, go ahead.
Hello. Hi. Hi. Good evening.
Hey.
Actually, sir, my question is that actually a lot of nowadays a lot of people are doing 90-20 strategy. Okay, so maximum people are putting stop loss at 30%. And if the stop loss hit on both sides, then how we can manage that type
Okay,
of drawdown?
Rohit, we'll come to that. We are not discussing the strategy right now. So I'm just trying to make sure that the framework is first explained. We'll come to that later. Thank you for now. Okay, I'm just gonna move on, I guess, for now, or maybe I'll have Darshan ask the question. And Darshan, if you have a question about what we've been discussed so far, not about the strategy or not about how to manage the SL, it will be useful. Otherwise, we'll get to the questions later. Darshan,
सबको नमस्कार
hey, namaste, Darshan.
सर आपने बिल्कुल सही कहा कि कभी कभी क्या होता है कि अपन स्ट्रेटेजी के प्रति इतना मतलब कि डेड श्योर हो जाते हैं तो दूसरे कॉन्सिक्वेंसेस जैसे विक्स बढ़ रहा है या मार्केट ट्रेंडिंग है वो देखता मतलब कि बिल्कुल ब्लाइंड कर देते हैं अपने आप को कि नहीं अभी तो ये स्ट्रेटेजी अच्छी चल रही है तो मैकेनिकल होना जरूरी है पर जो दूसरी चीजें भी है ना कि अगर विक्स बढ़ रहा है या मार्केट बिल्कुल दिख रहा है ट्रेंडिंग है तो अपन केवल प्रीमियम खाने के लिए एक स्टॉप लॉस ट्रिगर होता ही है उसके अंदर तो स्ट्रेटेजी के साथ साथ मैं कहता हूं मेरा ये मानना है कि मैकेनिकल के साथ साथ कुछ थोड़ी सी गट फीलिंग या थोड़ा इसमें इमोशनल भी होना चाहिए न्यूज के प्रति
Yeah, Darshan.
थैंक यू
Thanks for that, Darshan. We'll again discuss that. Okay, thank you. All right, so I'm going to continue speaking again. So for now, the YouTube stream has stopped. For some reason, I didn't realize it was not working. Sorry about that. So we're just going to continue the spaces. So if you go to the article, my reference to the article, it introduces the 920 straddle. I don't think मुझे ये introduce करने की यहाँ ज़रूरत है. Everybody knows, but for sake of completeness, it's a straddle in which it's a strategy in which in the morning at 9:20, 9:30, whatever time, you sell an ATM straddle, or some slightly in the money or out in the money strangles, and you put some stop losses either on individual leg or overall profit and so many other things, and you have an exit time, so you exit it out at whatever time you want to exit it. So that's a very basic strategy, and it's very popular. There are many people who are trading various versions of that strategy. On the blog post or on the Medium post, you will see I created a strategy which was a 9:30 a.m. Selling ATM straddle on Bank Nifty with 30% stop loss in each leg and exiting at 3:15 p.m. Now, with that, I use StockMark, which is of course the most popular and the easiest used to backtesting platform to use such a strategy or test it out. And I created an equity curve, which is again on the blog, and it assumes a 0.5% slippage. And if you see the performance is about 230 or 238% returns in over 5 years with approximately 12% drawdown. So this is typically an outcome of a backtest. You create some rules. We created 3-4 rules, and then it spits out this equity curve and historical trades. Like this strategy has about 1,200 or so trades in this backtest period with some drawdown. And then I kind of floated this question that, let's say if you're looking at the strategy, if you're just looking at this equity curve, which is a beautiful equity curve, again on my Twitter profile, if you want to go in, that link to the article should be right there. And then, would it be a good strategy? And, my answers when I first read it was like, yeah, this is a good strategy for whatever reasons. So then, a lot of people, who have interacted with, they use these back tests and then they start trading it. Now, what happens is when you trade it, let's say, like I was saying earlier as well, if you look at the equity curve of that strategy, so around mid of 2020, I think this must be around Corona crash or near about that time, the strategy started plateauing a bit for a few months before it took off again. I would assume this was the time when it was the COVID crash of March and late February, March, and early April. So let's say you had backtested this strategy in starting of 2020 or before the COVID crash. You start trading it, and right after when you started trading it, things changed, and the strategy started plateauing. You trade it for 6 months, and you realize 0% returns or 5 returns or -5, very flattish returns. Whereas in your backtest, you have a very beautiful looking uptrending curve, and when you start trading, it's suddenly flat. So the obvious question then to ask is, what happened? Did we mess up our back test, or has the strategy lost its charm? And that's really where this analysis of when to stop trading a strategy comes in. So in my article, I actually outlined two approaches: a qualitative approach and a quantitative approach. So let's talk about the qualitative approach in general first, and then we'll move on to the quantitative or statistical approach. And again, it's just one example. So a qualitative approach is wherein you start looking under the hood. You start looking at, you start thinking on what drives these returns. Why will the strategy make money? And please don't think theta decay is the reason this makes money. It's one of the reasons. Theta decay or vol decay or the volatility risk premium is definitely one of the aspects. But it's not the only reason why such a strategy makes money. But stepping outside the 920 straddle realm, if you're trading a trend following strategy, or if you're trading a pace trading strategy, or if you're trading any other long short strategy or any other format of arbitrage, so the first thing, and one of the most important things to do when you're trading a live money on a strategy is to understand what drives it returns. What is the reason? What features or what environment in the market or what regime in the market actually enables the PNL to be driven. And that's really the qualitative analysis bit of it. To understand the driver of the returns can help you then pile on quantitative analysis on top of that to really come up with a very robust answer. But both of these approaches, qualitative and quantitative, are not mutually exclusive and really essentially should be done together, hand in hand, one on top of another, or parallelly, if you want to call it that way. So my article again gives a small example of a trend following, and it has a gold chart. So if you're doing trend following in gold, you'll see the last few months that gold has been in a very broad range, and if you're doing it on a daily time frame, you'll see you might not have realized any positive returns out of it. So does that mean that trend following on gold is dead? I don't know. This is just one qualitative measure of it, and this will go for all of your stock trading. Let's say you're doing intraday stocks as well, or mean reversion portfolios. This analysis helps you understand what drives my return. So if we then talk about 920 straddle, what drives it returns, and I think there was a very interesting set of threads, I think last week, one of my friends, Roy, I don't know if he's here on the space, but I hope he listens to this. I think he started it, and then a lot of different Twitter handles responded to it. One of the very good examples answer was given by the handle Anandable, the conservative trader. So if you think about it, the reason 920 straddle makes money, if you think about the rules of the strategy, and I'm just repeating his words, and of course with my bit of my understanding. If you do qualitative analysis of a 920 straddle, so what happens is let's think about the days, the type of days the market may realize. So let's say it's a range bound day, and you started a straddle in the morning. Throughout the day, market doesn't go anywhere, it stays within a small range, practically saving both of your end of the stop losses. Again, this will also depend on what kind of stop loss you've had. A 10% stop loss has a higher chance of getting hit versus a 30% and a 40%, but at the other end, a 10% stop loss will only give you 10% loss on your premium, whereas a 50% stop loss will give you a bigger loss. But both have their own pros and cons. But assuming that your stop loss is not hit, that means whatever the volatility environment, or the IV environment, or the delta moves, or the underlying moves were for the day, did not hit any of the stop losses, and then you kind of hoping as the day passes, and depends on how close to the expiry you were, as the time value of the option reduces, it will probably, both these legs will reduce the value, and since you have sold them, you'll probably be able to realize some return in the end of the day. And again, this might, in a non-technical or in a very simple way, this is what DK is attributed to, even though DK has a lot more aspects to it. But for to keep things simple, let's say this is the DK. So your straddle DK is through the day. The volatility did not spike up, the market did not take a trend direction, and you are able to make that return. So that's one driver. So if we think about 920 straddle, I would say that VIX or the IVs or the IV curve not spiking up through the day, combined with a non-directional or a range-bound movement of the index, will likely drive my return for that day, for those kind of days. On the other day, there might be days wherein market starts trending. So it opens gaps or not gap. Let's say within first 30 minutes, 45 minutes, market start trending in one way. In that case, what will happen is one of the legs will go off. Let's say the market is trending up, so your short call will probably hit the stop loss, and you will be left with short put. And throughout the day, as market keeps on trending, this option will keep on getting more and more out of the money, and the value will decrease, and you will again make money. So that's another kind of days wherein this will make money. So these are the two broad P&L attributions. These are two broad profit attributions, I would say. Now, somebody, you have to think what will be the loss attribution. What kind of days is when this will make losses, right? So one of the example is, it will make loss on a range bound day if your IV spike. So let's say you with all the war situation going on with Russia and Ukraine, let's say the market is range bound, it's not moving, even though in a war situation you will expect some sort of market movement. But assuming, or let's say there's another day, let's say it's budget day, pre-budget era, the market doesn't know which way to, people don't want to take directional risk, but they want to hedge out their portfolio, so they will buy protection both on the buy side and the long side, which will essentially lead to increased IVs, or increased premiums, which will lead to increased IVs. So essentially you sold the straddle in the morning, market did not move, but IVs went up. So what will happen is, even though markets remain directional, in non-directional, and none of your call or put legs have hit their stop losses as such, or both of them might hit the stop losses, essentially the IVs going up will mean both of them will hit stop losses, even though market did not go up. So that's really one environment, or one loss attribution environment, wherein your IVs or volatility, or VIX, these are not interchangeable terms, but I'm using very loosely spikes. The other situation wherein, let's say your IVs stay almost constant. I shouldn't say constant, but let's say within manageable range. And what may happen is market may be volatile. So you understand, IVs are different than volatility of intraday volatility of the market. Our IVs are implied vols, or what the market sees as the expected volatility of your underlying option, or underlying asset on which the option is created going forward until the expiry, right? And of course, you can analyze it. And volatility is how the market is intraday. So it starts from, let's say, 35,000 in Bank Nifty, goes down to 33,000, then comes up to 34, then goes to 36. So it's a large move, right? And in that case, there have been different names for this. AKBC was a very prominent name. This day it's being W move, or V-shaped moves, in which what will happen is both of your legs will get cut off. So even though market remained at the end of the day, probably started at 35,000 and ended at 35,000, but it might have hit both the legs. So this price action or delta-based movement will also hit your stop losses, right? So even though the IV environment might not have changed. So these are two broad loss attributions. So, I think over the last few minutes, we've spoken about the profit attributions, which are A, constant IV environment and non-directional move will make this, or even falling IV environment will make this money. And B, a directional move in which IVs probably remain the same or fall, and the market trends one direction will make this money for the straddle. And the loss environments are an IV spike with non-directional move, or even with directional move. IV spike will likely hurt this system or strategy. And of course, a V-shaped or W-shaped move will also hit this, or dead the strategy. So these are the profit and loss attributions that anybody who's trading the strategy should think about before they start putting live money. And that's the qualitative approach that I talk about in my article on the Medium, that you should really understand what will drive what drives the P&L. And then with that said, then the other approach you can supplement this with, this is good, right? What we've talked about is good, decent, but like, how do you quantify it? How do you put numbers around it? And I will not be able to go into all the details of quantifying this completely, but I'm going to introduce a Monte Carlo based statistical approach, or quantitative approach, if you want to call it, to kind of give you the first step of analyzing any strategy. And I just use the 920 straddle as an example, but essentially it can be done with any format strategy. So let me introduce that. So what we can also do is, and again, if you are listening to this, I would highly recommend looking at the article, because it might just help you understand what I'm trying to say here. So one of the assumptions, when we think about a statistical approach, we think about a lot of distributions. It might be distribution of returns. It might be distribution of any other underlying process. So a distribution is essentially, if you ever seen a histogram in your life, that's a distribution. It just says how many times an event occurs in a given space. So for example, let's say you have people might have seen normal curves or Gaussian curves or bell distribution, a bell curve, in which you have this opposite V, or an A kind of a curve without the middle horizontal edge in it. Essentially, you have this, most of your returns are in the middle, or whatever the mean of your distribution is. Let's say normal distribution has a zero mean, so essentially a lot of your realized returns are around zero, which is also the case in your trading as well. A lot of your returns might be between, let's say, plus 0.5% and minus 0.5%, and then you might have some outlier returns depending on what kind of strategy you follow. So for example, a trend following, as you might know, has low win rate, which means it wins low, but it has a high win amount on the win. So it will win, let's say, 10-15% when it wins, but it lose 0.5%, 1%. So when you try and plot those returns on this distribution chart, you will see a positive skew, which means there will be a large returns on the right side of the curve, the positive side of the curve, but lower instances, only 1, 2, or 3 returns, such that. But there'll be a lot more on the negative side, so 100 returns, which will be minus 5.5%, or maybe 10 returns, which will be minus 1%, and so on. So it has a positive skew, which means the bell curve has a fatter tail to the right. And then you have negative skew, which is opposite in case, in which usually the straddle selling or option selling falls into, in which you will have constant small winners, essentially, let's say plus 1%, plus 0.5%, very frequently, and relatively, so high win rate, and relatively less large losses. So that will be the skew distribution or negative skew distribution of a straddle kind of a strategy. And of course, depending on your rules, you can create your strategy distribution. You can hope to target a different distribution, but again, I don't want to get into those details. So that's what the strategy, what the distribution is. So, and when we create a backtest, what we assume is, one of the assumptions implicit in taking live a backtest is, whatever distribution of returns we saw in our backtest, we expect that distribution to remain constant over observable next observable period. It might be 3 months, 6 months. Again, I'm speaking this in a very loose fashion. This might not be very accurate and to the T when it comes of the statistical terms, but again, that's really the assumption that, and if you think about it, that's what you expect, right? You've done a back test, and when you take it live, you want to assume that my returns, my performance from back test will replicate in my live returns. And that's why statistical way of looking at it is saying and assuming your distribution of returns is going to remain constant, so over the live return. So essentially what that means is, if my back test is 5 years, it generated 240-238% returns with 12% drawdown, I would want the next 5 years, or I would expect the next 5 years to have a similar performance. That's an implicit assumption with taking a back test live. And that's all, that's the case with our article and our analysis as well, that we implicitly assume that. So with that said, with that understanding that when we take a backtest live, this is how we are thinking about it. One of the things to understand is the drawdown. The drawdown itself could be thought of a statistical process. Now, what do I mean by that? And I think for this, you really should. Let me introduce Monte Carlo simulation first, and then I'll try and drive the point of why I say the drawdown itself might be a statistical process, and what do we do with that analysis. So what is a Monte Carlo simulation? So Monte Carlo simulation is nothing but reshuffling the order of the trade. So for example, I'll try and explain with, let's say, 10 trades. You have a strategy which has only 10 trades, and let's say you decide in your minds, whoever is listening, that okay, how do you think first 4 were winners, first 5 were winners, first 2 were winners, alternate 2 were winners and losers, or whatever way. So you have a stream of 10 PNLs that you are looking at now. And when you let's say you create a equity curve of that, you will create a backtest kind of an equity curve, which we have also seen in the article. Now, if I tell you that you can reshuffle this, what you can do is, trade number 1 to 10, you have these returns. Now you change the order in which they occurred. So let's say in a first case, our first return was 1%, next return was 2%, and then -1 and -2. Okay, so let's say these were the first 4 returns: +1, +2, -1, -2. Now I say you can reorder this in any way or form that you want. So let's say each of you, I'm sure if I ask you, you will come up with different ways of reshuffling it. And even though this is only 4 returns. So let's say for me, I will say, okay, I will say +1, -1, -2, and +2. Okay, that's how I have reshuffled it. Now you see, it's the end result for both is exactly the same. It's 0% return, assuming there's no compounding. But the drawdown of both of these strategies is already different. So you have the same set of 4 returns with same daily returns, but depending on the path or depending on the order of the returns that were generated, your drawdown is different. So what I'm trying to tell you here is, the backtest we ran is just one example. So if you have 1200 trades like in our backtest, if you reshuffle the same trades, exactly the same trades, you will come up with the total returns will be the same, but your backtest drawdown might be different. And that's what Monte Carlo analysis is trying to do in a computational environment. It's trying to reshuffle that. So I have a graphic on my article which is saying, okay, you have starting point A, which is usually a 0% return, and you have ending point B, which is your whatever 230% return. You can go from A to B in many ways. And I just demonstrated one of that. And if you look at the article, I have an example in which I ran 4 simulations. I kind of reshuffled these returns 4 times. One simulation is one reshuffling. Once you reshuffle, you recalculate the total P&L, which will exactly be the same. But since we are looking at drawdowns here, you reshuffle the returns and you calculate the drawdown. So on the article, there are 4 colored charts. 4 lines on the same chart and a black curve. So black curve is where our basic backtest was, and then there's a red, green, blue, and orange line which shows the 4 different simulated results. And I noted, and I've mentioned it. If you look at just the chart, you will say I've asked this for the reader too, that hey, from these 4 equity curves, pick which one do you think is what you like the most or which you would want to trade. And you will be amazed how many times people will pick something, and then when I reveal the drawdown numbers, they'll be like, oh shit, this is not what we expected, because what appears very beautiful to naked eye may not be very, when you start digging deeper into it, might be very different. And that's what I did. So in the article, I say, hey, pick up one of the equity curves, one of the colored equity curves, and assume you traded this live, and what will be the drawdown. And I'll give an example. So our backtest has 12.75% of drawdown, but these 4 simulations had 11.5 or 11.2. Then second was 15%, third was 23.88 or roughly 24%, and fourth was 21.35% in terms of drawdown. So exactly the same starting and ending return, but very different drawdowns. And that's the point we're trying to make, that our backtest drawdown, 12.75%, is one possible path with the same set of returns that the strategy might have taken. Now, let me take a step back before we go further and say that, there are many caveats to this. Depending on your strategy, there might be clustering of returns, like trend following is one such strategy in which a lot of losers come together and a lot of winners come together. Even in this strategy, the 920 straddle we are talking about, your expected returns on Thursdays are usually, or the option expiry days are usually highest versus, let's say, on Monday or a Friday. So, when you reshuffle it, it's reshuffling in a way that, let's say, all Fridays get stacked together, all Thursdays get stacked together. So your returns might be, not really true. And, that requires a digging deeper analysis. But the one way to ensure that your analysis is still meaningful is deciding the cutoff of your drawdown distribution, which I'll come to in a few minutes. But essentially, that's what Monte Carlo is. You take your realized returns or backtest returns, you reshuffle the order of those returns, and you decide and calculate what's the maximum drawdown for me in that returns. with that said, before we move on, I just again want to pause. I have a few speaking requests. I'm going to take them and see if they have any questions before we move on. So I have Saurabh and Himanshu. I'm going to allow both of you. Saurabh, if you want to go first. Hey Saurabh. Yeah, Saurabh.
Yes, sir. This is so. My point is, you said that when to stop trading it. There are two methods. We can say there are 2 points. Let's say it's a flat or it's a negative return. It is generating over a period of time. Okay, that is one way of looking at it. But can we do the reverse if it is making the negative return? Can we trade the opposite of it?
Okay. Saurabh, thanks for your question. But essentially, saying that trading the opposite side of the returns allows you, you can trade it, let's say strategy is going down. I usually short, but I'm going to go long. Is usually not the right way of approaching it. And again, today is not, we are not trying to discuss what's the right way. We are trying to, if you read at the article, you'll see what I'm trying to explain here from an slightly analytical perspective. I'll have Himanshu speak next. Himanshu?
Yes, sir. Hello. Am I audible?
Hey, Himanshu. Yes, Himanshu. Please.
Hey. Sir, I have a question. And then you said that in a Monte Carlo strategy, we can reshuffle trade. We can reshuffle also like that. We have a max drawdown of 20 days. Sorry, max losing day are 20. Hello.
I'm not sure if I follow. So you're saying, we can reshuffle the returns, but you're saying you can also change the number.
Yes. Can I just complete? Then you can answer, sir, please. Like that, okay, we can lose regularly for 20 days. Then we reshuffle the 20 max days when we lost. This also can be a max drawdown for that strategy.
Right. So what you are, I get it. Okay. So what you are saying is, let's say our if our strategy has 100 days of returns, and then we pick up the worst returns of the strategy, and if we assume that might be the worst case, then that can also give you a good answer. Yes, that's actually a very fair answer. And once I explain the distribution, the drawdown distribution, or if you go to the website on my article, you'll see I've mentioned the 36% number, which is essentially the tail of the distribution. So what you are explaining, what you are saying is that what is the maximum possible way in absolute worst scenario in which all of your worst losses get stacked up, what will be my drawdown? And yes, that's a very simple way of saying, absolutely wrong or absolutely worst situation of what the returns this strategy might represent. So that's also a very simple way of doing it, but that's usually the extremist case. If you start doing this with all of your strategies, you may probably never end up trading one. But I'll also cover that once I come to that. I'll have two more speakers speak before I continue further. So Kapil, we can have your question.
Yeah, actually my question was similar to that Himanshu.
Can you repeat? Can you say your question?
Yeah, my question was similar to that Himanshu, that if we are doing the stimulator, means in the initial stage we put the maximum drawdowns like 20 days like that. So you said that in your article, you said that the 2 times of your drawdown you need to exit. Okay.
That's one of the popular. Yes, that's one of the popular.
Yeah. So in the initial phase where we get a maximum drawdown, like you have given 10,000 types of permutation and combinations. So it might be that when a person enters at the right time of the drawdown phase, because he don't know the market behavior, how it's going to, we also don't know what tomorrow happens. So at that time, initial stage, when he reaches the maximum drawdown in the stimulator like 20% or 21, and the next after 15 20 or 1 month or after that again he goes on, means he sees the same drawdown maximum of around 40. So it has been more than 2 times. So the overall profit that you said it 238%, that I accepted, but how will be the confidence of that person to continue with that
Yeah,
this
yeah.
thing?
Thanks. No, I get your question, Kapil. So let me try and answer that. So
Hmm.
the thing is that gaining confidence is the toughest part of trading a strategy, right? And what I have tried to explain in this article is one approach. Like all these statistical tools which are used or which are provided are just like if you enter a kitchen, there are different kind of utensils, there are different kind of knives and boards and whatnot. You can't really come up with an answer with one of that number, right? And that's why I was explaining earlier the qualitative analysis that needs to be done, and quantitative can help you. So to answer your question, that if it hits, if that happens, I would say look under the hood. If we discussed four PNL attributions, or two profit attributions, two loss attributions of the strategy, and then in what situations is the strategy will be making money and will not be making money, and you kind of marry the two. You marry what's your historical drawdown, or what was your simulated Monte Carlo 95 percentile drawdown. Again, I'll like to explain that quickly next few minutes, and then see what is the realized return. And with all this information, I wish it was that black and white to say yes and no. The answer is really gray. It's in the gray area. And I'll once I'm hoping in next 10-15 minutes I'll complete my side of things, and I'll have, there are so many, when I posted this on Twitter, I got so many good responses, very uh, interesting ideas and thoughts from people. We like love to hope to discuss that on the space. But next few minutes I want to complete this, so I'll have Praveen speak next. Praveen, if you want to unmute.
Yes, Ankit,
Yes,
can you hear
Praveen,
me?
please.
Yeah. First of all, thank you very much for posting this article. It has given a lot of new insights for me, at least. I am a systematic trader, as well as I do some discretionary trades as well. And as you also know it very well, for systematic trader, we have to find middle line perfectly. Uh, what I mean to say is, if we uh, as per your Monte Carlo analysis, whatever 10,000 simulations you have done, if we just take a favorable curve for us, wherein maximum drawdown is very less, it could be in the range of say 3 to 5%. If we go with that kind of assumption and put our position size in line with that, we will have very high risk of ruin. Whereas if we take extreme case, which is worst case, probably you have considered 95 percentile, suppose we consider 100 percentile, then in your article you have posted it could be around 32% of the maximum drawdown. In that case, what I feel is, for a trader we have to identify the middle line. If we go with 31% as the maximum drawdown, and with that consideration if we put our position size accordingly, then I feel we are not utilizing our position optimally to get the maximum return. So here the question comes, what percentile would be the ideal? And I always keep on struggling to identify that. You have mentioned 95 percentile could be considered as ideal, uh, because you have considered the worst of the worst scenario. But what I would like to understand from you is, my logic is very simple. As you explained in earlier part as well, we are at first doing qualitative analysis. There are some underlying logics wherein we are putting in this, let's say, case of 920 straddle. So as you mentioned earlier as well, in Monte Carlo simulation, if we consider 10,000 runs, and in that if we consider last 5 percentile worst case scenario, it will definitely consider choppy market scenario put together, as well as you mentioned earlier, Fridays and Tuesdays where maximum losses are coming. So that clustered result, if we consider in our actual position sizing, then we may not be getting optimal result. So what I feel is, instead of 95 percentile, considering the qualitative analysis, which at start we have identified to begin with to run this particular strategy, what I feel is 60 to 70 percentile should also be okay. My logic for this is, first of all, as you mentioned, 95 percentile, it may not happen so easily because we are running this simulation for 10,000 times, right? And we are considering 1200 trades which have occurred in last 5 years. If we consider 10,000 simulations, in other words, we can say that 10,000 multiplied by 5, so 50,000 years of trading. If we consider, in that scenario, it may happen that the worst case 30% drawdown or 31% drawdown, whatever it is coming, it will come in 50,000 years. If we continue to trade this 90-20 straddle, 920 straddle for next 50,000 years, then we will get 31% of the maximum drawdown, right? So
So
in terms of probability also, 1 by 10,000, it hardly gives 0.01 percentile, 1% probability to get that maximum drawdown. So what I feel is, instead of going for 95 percentile, if we go for, say, not middle, considering factor of safety, say 60 percentile or 65 percentile, that should be enough. That is point
okay,
number one. Another query which
Praveen,
I would like you to
Praveen,
yeah,
let's take one query at a time, right? So let me
yeah,
try and address some of these things, and I would ideally like to continue the presentation so that anybody who has not seen the Monte Carlo simulation or might have questions around what a simulation is can get that answer too before we move to another question. But let me try
okay,
and answer your question. So you're right in some aspects to say that at the end of the day, this is a simulation, and if we take the worst possible simulation, that's really, it's not the best efficient use of capital. And if we take the best possible simulation with least possible drawdown, 2%, 3%, then we have a very high risk of ruin. I completely agree with you. The reason 95 percentile is chosen, and if anybody follows a bit more statistical analysis, you will see it's a very common cutoff, which is used in distribution analysis and some of the statistical tests. If you've ever done t-test, student t-test, or p-values, the idea is that at what point do I distinguish something which is randomly happening with something which is happening because of a reason? And that's where you want most of your distribution or most of your analysis to fall within the 95% band. And that's where this 95% comes with. Now I'll give you another example. In a normal distribution, a one standard deviation from the mean happens 68% of the time. Two standard deviation, I'm not sure what the exact number is it 90% or
it would
something?
be 94%, 94%.
94, right, there you go. Three standard deviation is 97 or something. So that's also where these 95 percentile cutoff comes in. So when you are taking in the 60-70%, when you're talking about that, you are essentially saying one standard deviation, which is a much more frequent occurrence than you would otherwise believe it to be. So what I mean by that is, see, we are trying to here assess here when to stop it or when to see here something has changed. If on a one standard deviation basis, I expect 68% of the times within the one standard deviation my outcome will lie, then the cutoff 60 to 70% will be much, much more frequent, which means we'll start reassessing that strategy for its stance very, very, very often. Rather than that, we want to be in a situation, or at least the aim of this analysis was when to start getting concerned about it, or when to start thinking that something might have changed. And for that, you would need a slightly higher cutoff, essentially, which is this 95%. So that's where the 95% motivation comes in, right? So with that said, no disrespect to you, Praveen. I just want to complete the rest of the article so that we are all on the same page. Anybody who might not have understood, it will take another 5-10 minutes, and then we'll have open-ended discussion on this. So coming back to the article, so we've drawn 4 alternate paths or 4 Monte Carlo simulations. It was done to visually make people understand what a Monte Carlo simulation is trying to do. It's trying to create alternate paths. But the whole idea of a Monte Carlo simulation is to run it a few thousand times. And the premise is essentially, we do not know the mathematical framework or mathematical model which drives these returns. So still, since we do not know, we just assume, we make a few assumptions. So Monte Carlo has an assumption of randomness, which means that all these returns that we have generated can occur randomly at different times, which is also not true in our case of 920 Straddle. We expect them to be more clustered, and that's why a more enhanced Monte Carlo might be a more suitable one. But again, like I said, this is a starting level analysis that I wanted to show. So yeah, Monte Carlo simulation has that assumption of randomness, and it will reshuffle it. It also has an assumption that your distribution will remain the same, or the process which is driving the returns will remain constant in the future, and that's where you can rely on that, which is again not the most coolest realistic of assumptions in trading. And if you've ever done any kind of mathematical or modeling on statistical modeling on financial markets, you will understand that these are all with assumptions which often do not occur to be true in real life, in real trading. But again, we work with those frameworks. If you ever look into Black-Scholes framework, which is the option pricing framework, it also has the normality of underlying returns, or the normal distribution of the underlying as an assumption, which is never the case. The asset returns are more leptokurtic, or has fatter tails, if you want to call it that way. So, but nonetheless, the frameworks are always driven with some assumptions, so it makes our complex world slightly more simpler and slightly more understandable. And that's what Monte Carlo is trying to do. So, armed with that knowledge, we just go ahead. We repeated the experiment 4 times, and now we're going to repeat it 10,000 times. Instead of having 5 or 7 returns in our stream, we are going to do this, on the entire backtest space. And that's what the second curve on the article comes out with, the Monte Carlo curves of 10,000 runs. You will see the same set of returns could have taken so many different paths. Now, visually, you could have gotten the similar understanding within, let's say, even 100 runs. But if you look at the chart closely, wherever there is a curve which goes out of the whole big band, like if you think of this visual as a rubber band, and then you will see there are curves which will often go out of it, and they're all different colors, which means the deviation from like a whole cluster is also pretty prevalent. And that's what a large number of simulation helps you capture. It really helps you capture those tails. And then we're going to cut off the tails, which we're going to talk about. But what I mean by tails are extreme returns of positive returns and extreme returns of negative returns. And ideally, we want to cut off both of them, and hence the 95 percentile that we were earlier talking to. But the more number of simulation, usually above 1,000, 5,000 are good enough. And again, it depends on the use case, what kind of strategy it is, what kind of underlying. If you have 1,200 trades, you run 10,000 simulations, you're actually running a lot of simulations. If you have only 100 trades, you might want to run a lot more simulations, because probably add some noise as well in your simulation. You can do a lot more with Monte Carlo. But essentially, in my article, I took the base returns, and this went on and plotted the 10,000 returns. And after that, the next chart on that page is a histogram. This histogram is the distribution. Now you bin these returns of drawdown. So essentially, each curve or each simulation gave a drawdown which was stored, and then we bucketed them. So the buckets are, let's say, 0 to 0.5% drawdown happened less than 1% of time. So if you look at the curve, under 1%, under 10% drawdown happened less than 1% of time in each instance. And in the cumulative curve, is the green curve on the distribution chart, is also very low. As you move more realistic to between the 10 to 15% range, so 10 to 10.5 is one bucket, 10.5 to 11 is another bucket, so on and so forth. It plots the percentage of the total simulations which were within that small bucket. I don't want to get into how to plot a good histogram, or you can change the bin sizes to change the percentage. So, if, for example, if my bin size is 10 to 10.5%, the number of, let's say, in 10 to 10.5%, we have 2% of drawdowns, and 10.5 to 11% of drawdowns, we have let's say 5% of the whole simulations. So when we club those two, so between 10 to 11%, we'll have 7%. So your the percentage of your simulation which fall under a bin size also is dependent on the size of the bin, and that's also a, one of the analytical tool how to select the sizes. You select small sizes to get more granular output, a more granular view of your analysis. You select slightly broader or wider bin sizes to get a more holistic or wider view of the distribution. So that's what the article does. Then it really plots that out, and then it plots a few things. So the blue chart, the blue histogram, is the distribution of the drawdowns in our simulation. Then it has a purple vertical line, a dotted line, which was the original drawdown in a backtest, which was essentially the black curve, uska drawdown, whatever it was. It has a brown dotted line, which is the 2 times the drawdown. So easily a lot of times you'll see people say backtest, whatever the backtest drawdown is, you double it up and you kind of use that as a benchmark to stop trading a strategy. That's the brown line, which is essentially in our backtest 25.5%. And then there's a red dotted line which goes and meets the green line curve. So green line curve, think about, is the percentile curve going from left to right. So what it means is, on the x-axis is your drawdown. So if you go from 0% drawdown to 35% of drawdown, green line and the right axis shows what percentage of your simulations had that much drawdown or less, just like a percentile. So green line, the red line meets the green line at 95% cutoff, which is of course I've defined in my analysis. And essentially what it is saying is that 95% of the time in our simulation, my drawdown was less than this red line, which in our case comes out to be 21.99 or 22% roughly. So again, now when you look at this image, this is just one analytical output. And this is not, I'm not trying to say, or I'm not trying to pitch that this is the only way and the whole and soul of coming up with this conclusion. This is one data-based output which you can analyze. So you can easily see in this strategy, or the 920 strategy that we created, this red line is better than, or the brown line, which means the 2 times drawdown was more conservative than what a Monte Carlo simulation gave us, right? Whereas if you scroll down further, and you can read through the rest of the article on that, which explains some of these, and of course I can answer these questions if you want to. But essentially, the last section of the article then talks about a word of caution. So I have given another distribution curve from another strategy that we run at Decibel Capital, which has a historical drawdown of only 6%, so essentially half of our 920 straddle. But when you draw the distribution of it, your 2x of drawdown comes to 12.5%, but a Monte Carlo simulation comes at 15%. So what I mean to drive by this, what point I mean to drive is, if I'm trading this strategy, and if I use 2x as my cutoff wherein I would stop trading a strategy, then I'm not even covering 95 percentile of my simulation itself. Again, the caveat is it's not the only way of looking things, and there are quite a few assumptions in this, but I just wanted to bring out that that example in which, so we have 2 examples now in which this 2x of drawdown has been conservative, which is our 920 straddle, and another example in which this 2x of the drawdown has been more aggressive than our real backtest. And without doing some form of data analytics, it's hard to come up with that assessment, whether this is more conservative or what to expect. So with that said, that's what the whole article was all about. And I just want to cover one thing here, which a lot of people provided feedback on, is about the clustering of returns. So when we do a Monte Carlo simulation, it is really stripping the returns of all its features. So it doesn't know when the return was generated on a Wednesday, on a Thursday, or a Friday, or OPEX, or budget day, blah blah blah. It just takes everything as same return, and then or same sort of process, and then plots it out. A more robust way of just doing 920 straddle based Monte Carlo is to probably group your returns on the days. And I would rather assume and suggest using option expiry as your benchmark rather than calendar day. So option expiry day or day of the OPEX -1 or OPEX -2. So days to expiry as 1, 2, 3, whatever you want to call it, and then do this analysis again, because then what you're kind of, but again, in that approach, the assumption is that I'm saying my returns on Mondays are similar across my backtest. And if that's your assumption, then by all means, go ahead and do that. And even if that's not your assumption, I would always say go ahead and do that. You never know what you'll find in your data analytics. A lot of time, you do not know what to look at, so you start punching, you start creating these charts and graphs and come up with interesting observations which you probably would have never thought about. A lot of time intuition is driven by data analytics and not the other way around. A lot of time intuition drives data analytics. Like in our case, we would expect Thursdays to have most returns. So if I were in that case, I will do a seasonality analysis of my returns. I will plot the returns of Thursdays or OPEX and the other days and see if they are meaningfully the same, right? So there is a lot more to this than just Monte Carlo simulation and this analysis, but this is just one starting point of assessing whether 2x of the drawdown was good enough or not. So with that, I think I've covered the article. Praveen, I know you have spoken once. I know you had another question, but I see Sundar and Theta, I'm sorry what the handle is. I'll have them speak first, and Praveen, then we'll probably get your question again, if you don't mind. So I'm going to allow... thanks. Sundar and Zubre Khan, Theta Eater, sorry. So both of you are now speakers, but Sundar, if you want to start first, because you are first online, and then we'll go to the Theta.
It was nice actually hearing you talk about 920 straddle, and the article which you wrote earlier today, it was really good. I have some questions. Let me start off with this question. Most of the backtests which we run now is based upon the premise that the cost of trading a straddle was around 20 to top most like 30 or 40K. So now the cost of trading has gone up really high, in the sense that after peak margin came in, now the cost of trading one straddle costs around minimum 2 lakhs now in our Indian market. So is there a way that we can quantify how that will affect going forward? That is my question first. I believe let's speak about that. Then if it is able to be answerable, then I can ask the next question.
Sure, I can try. I can take a stab at that. So you see, in my analysis, what I've assumed is I've assumed a capital of 2.25 lakhs or 225,000 rupees for the entire backtest. And you're right. If you were trading these straddles in 2017, you probably did not need that much margin. This is driven by the current margin state. So you can essentially, in the code, I've shared the code on the article. It's in the GitHub. Anybody who can use Python or any other coding language can easily see that. But it's also very easily possible to change your capital, based on the margin requirement to really create a more robust return distribution. So if I were try to do that, what I will say is, let's say the margin requirements changed September 2020 or September 2020 or so. I think they changed, right? Or 2021, September 21.
No, it started from October 2020, and they phased in like phase 1 till phase 4,
right.
which maxed around 2021. Yeah.
Right.
Yeah.
So let's say if I have all the date timestamps in my analysis, I can say, okay, in my backtest, I'm going to assume. So my backtest, this is a stock mark backtest, so it gives you an absolute number of PNL. 1,000 rupees, 500 rupees, 600 rupees for trading the straddle. And they also take into account the lot sizes, which essentially in your backtest you should do as well. So let's say I have 500 rupees on 1 lakh, 1.5 lakh rupees in 2017, and 500 rupees in 2020 will be different percentage returns. Right now, my analysis assumes 225 or 225 for the entire backtest. You can customize that. You can say, okay, October to December 2020, I'll assume 1.6 or 1.7, and so on and so forth. Again, it's it could be seen as really curve fitting, but this is also realistic to assume that if you were trading at that time, you might have used that capital to, and that might change your returns distribution, that might change your drawdown. It can change a lot of aspects of your backtest and analysis. But yeah, I think that's very easily doable. Now, whether you can build a model to predict in future, there's no way, because all these decisions are taken by SEBI at their own, at their own peril, so to say. So they decide what the margins should be, and there is really no way to predict or forecast that. But you can definitely
All right. Yeah.
make your analysis more realistic, right?
Yes, yeah. I got your answer on that. So we can't actually predict what may happen coming years, what may happen with this strategy. That is one thing. Second thing is, how about how can we quantify? Is there a way to say that if a lot of traders are trading the same strategy? Because I too run one of the stratas 920 Straddle in my system, so I too trade it. So what happens when a lot of traders start trading the same system? Not the same system, different variations, but still punch the orders at 19. What really happens? Is there a from your experience, can you put something like this was one of the strategy which I know for 10 years back was working really well, and then a lot of people started trading it, and there's a lot of returns came down. So is there a way
Yeah.
that you can tell anything like that?
Yeah, sure. That's actually a very good question, and please forgive me for probably a long answer that I'm going to try to give. So, return, this is where the return attribution or the qualitative analysis that earlier I was talking about, and I'll give you a couple of examples of things which have persisted through the time and things which have gone away. So, for example, if you think about trend following in Indian markets have been there for a really long time, whereas in US markets, US equities or US commodities, global commodities, there was a good bullish era of trend following in 1980s till early 2000s, and then it has been flattening out, right? And that's the thing with trend analysis, is that different asset classes will trend at different times. So that is something which is more or less prone to not prone but more immune to what do you call it, cluster, more people starting to trade it, because it's a capacity, it's the capacity for that strategy as a principle, or that style is lot more than what it used to be. But having said that, the reason probably it stopped working, in at least in the US markets, is a lot of CTA funds came up here which started trading a similar style trend following, and that's why the returns diminished. At least on the principle, on the theoretical basis, you expect the returns to diminish when more people trade it. But it really depends on the effect. Like, so for example, the risk premium, in the equity market. So what that says is, in theory, it says that your equity markets are risky. You are being compensated for the risk that you take, because your equity can go down and the company can vanish and whatnot on an overall basis, and that's why you expect to earn a risk premium on the money that you have put into equity markets. Now that is a, what do you call it, a fundamental feature of the market, and expected to stay forever, or at least for a good enough time, until nobody can say for sure, but it's expected to last much longer. So if you are trading a strategy which is harvesting the risk premium, which is essentially a buy and a hold of index fund, for lack of better word, then you would expect it to continue working in the future as well. So those are the examples which are more robust, or the capacity constraint is not that much. But I'll also talk about where the capacity constraint is there, which is, for example, an arbitrage strategy. And I'll talk about, in the years 2013, 2014, in the crypto markets, in the Bitcoin space, for example, a lot of exchanges were coming up, and they would have, because Bitcoin or crypto is not a centralized market, it's decentralized, you will have different prices on different exchanges. So essentially what you can do is you can buy from one exchange and sell on the another one without having to take that risk. It was really riskless profit, if you, as long as you are able to do that cross, right? Now, as more and more people started getting into it, so this was called cross exchange arbitrage, and as more and more people started doing it, this vanished away, because it was only this kind of an effect was capacity constrained. You can't have everybody trying to buy from one exchange and selling at the another, because it will react, the prices on the exchange on which you're buying will react to that demand. So it was that sensitive to the order flow, for an example, right? Now, when we, with that thought, when you come into the 920 straddle space, and if earlier, if you were on the space, I talked about the profit drivers and the loss drivers of the strategy. So profit drivers being IVs remaining same and market, or IVs going down and markets remaining in the range, or IVs remaining the same or going down and markets trending. Both cases will help the 930 straddle, 920 straddle. And then in the loss scenarios wherein IVs rise or market goes a V or W shape is where the losses will arise. So now, if we have to do a qualitative analysis, we have to see, okay, if 10,000 people, 10,000 traders, or let's not talk about in number of traders, think about the capital which is being deployed on this and the liquidity of your underlying which can digest that capital. That's where, it's not an easy answer, but I guess I'm trying to provide the thought that what can make the strategy crowded. Will it get crowded? Option premium, volatility risk premium exists in the market. Everybody knows it. How you extract that, it's a different feature. So maybe 920 straddle in its current form may or may not work, but it may evolve into a new format. I would say that would be my answer.
Okay, is there a way market will compensate for us putting more funds to trade the same system, which we have been barely putting like 5 times lesser, like 2 years back? For example, in 2018-19, it costed very less to trade a straddle, and now we put in more funds to trade the same system. So, is there a way market may compensate? I'm just not asking market to compensate. Just asking, is there a way that it might do? The premiums might inflate, or we might have a better returns on the funds which we are deploying in this strategy.
Yeah. So you see, you have to think about in terms of the underlying risk and not from the capital that you're putting into it. You can trade the straddle with 2 lakhs. I can choose to trade the straddle with 1 lakh and much higher risk, assuming we get the margin. Somebody else might trade it with 10 lakhs with one straddle and have much less risk. So, this definition of risk is as a capital driven risk is not really the risk of the strategy or risk of the market dynamics, right? Risk of the market dynamics is how the premiums behave. So the premiums don't go up because the margins have gone up. The premiums will go up if the expected volatility or the implied volatilities will go up when there is a more uncertainty in the market, and that's where the premiums will go up. So margin, I could be personally very wrong, but I think change of margin requirements may not reflect directly into the premiums. Now, there is another effect that has taken place actually, now that I speak about it. Because of the increased margins, we have seen a lot of people have started buying OTM hedges, right? As a result of which, the OTM hedging prices, like the prices of OTM have gone up, right? Which essentially means your skew of the IV curve, or if you plot your IVs across the strikes, has changed. So that is where the margin requirement affects the IV curve, which is which you're trying to harvest. So yes, everything in the market will have an effect, but maybe not in the same fashion. So like you were saying, will market compensate us more because we have to put more capital? I don't think so. Not directly, at least.
All right. Thanks, Ankit. Thank you.
Thanks, Sundar. Okay, I'll have more speakers come up if they want to. It's been speaking for a while. There were a few speakers. I think they dropped off with the long conversation we've had. But I'm happy to take any more questions if somebody might have. Okay, I have some coming up. All right, there you go.
Hello, Ankit.
Zubin? Yeah.
Hi, Ankit sir. So I've backtested the data. Like even I'm a system trader. But the thing is, I trade in Nifty. So for 3 years, like 2019, 20, and 21 till July, the lot size was 75, and later the lot size has been reduced to 50 in Nifty. So like when we backtest the data, so after June, July, will I have to change my lots, or the premium has been compensated for that?
Hello.
So hey, sorry, Win Trader, can you just wait for a minute?
Sure. Thank you.
Yeah. So you see lot size and premiums. So let's think about it. When you look at a premium on the screen, it doesn't show you the lot size. So premium is for one option. Your lot size is 50 of those. So when you see a premium of 400 rupees on Bank Nifty option, let's say any option, and you try and buy it, you don't pay 400. You pay 400 into 25, which is a lot size. So that lot size can change to 25, 20, 50, 40, whatever might be the situation. It will not have an effect on the premium. And the reason being, if you look into the Black-Scholes framework, which is the most common framework to price the options, there is no input of the lot size itself. So the simple answer is no. The lot size has no effect on the premiums. The things which have effect on the premium are the underlying price, the strike price, time to expiry, volatility, and usually interest rate, which practically is non-existent or least of the concern. But lot size will not directly impact the premium, if that's what your question was.
Okay, sir. So thank you.
Okay.
So the last question. But the thing is, like I've seen the drawdown from July. It has been more like 2019, 20, 21. Before, like 2021 was exceptional, like till February. But after June, the due to the premium, like I have the data of the premium also, like the premium we used to get before and the premium we are getting now. It is way too much.
Right.
Like,
So those premiums are different due to the different volatility environment. So in your pre-COVID era, or at least in 2017, 2018 era, there was not much volatility, and that's why when you're writing, so think how the option price. I don't want to get into option pricing in this space, but let me try to take a quick stab. So think about an option insurance, right? When you buy an insurance, if you have any form of illness, or let's say if you're old age, in which the insurance company thinks that you might be able to draw on that insurance policy, they'll charge you a high premium. So the option premiums, one of the option premiums, the reason it goes up is the uncertainty around between the time you're buying or selling the option and the expiry. So when there is more volatility, there is more uncertainty, which can lead that option to be out of the money, in the money, and can the payouts are very path dependent, and that's why the option premiums are different than what they were earlier. Also, if you think about the index level, so index level in 2017 was what, 12,000 Nifty. Now it is 17,000. So 1% move in 12,000 or 12,000 is different than 1% move at 17,000. So your option premiums will also expand with the underlying level, and that is why you will always see Bank Nifty options to be. So the exercise, if anybody wants to test it out, you take the same volatility of two instruments and you take different levels. Your premiums will be different because your realized percentage moves on the volatility will be different, right? So an option with 10% volatility on, let's say, a stock which is ITC of 100 rupees, and 10% volatility of Nifty will not be same price, because that 10% move can lead to very different outcome in the underlying level. So that's also the reason that your volatility, the premiums are different, different volatility environment and different underlying environment.
okay, sir. Thank you so much, sir. Thank you so much.
Thank you. All right, Win Trader, please go ahead.
Well, hi, evening. Well, thank you for hosting the space, Ankit, and sorry I joined a bit late. My question actually might just have been answered if at all, but please let me know. In which case, I'll just watch the recording. But I want to ask you that in the Monte Carlo simulation that you've done, are some of these tools easily available on the net, I presume? And secondly, of the sort of that bar chart diagram that you draw, one is obviously to take the max drawdown in that Monte Carlo as one worst case scenario, and then sort of work with it. That okay, if I get that, then I'll probably stop this. Straddle. But is there a better way to look at it? In the terms that should I take more more an average of something out of that Monte Carlo and then look at it or something?
Yeah. So let me first answer your question around the tools. So in the article that I shared, I've also shared the code. So anybody who can code can take motivation from that code. It's also on the Google Colab, so which is a free framework online from Google. So you can use that. I mean, it's not like I used a pre-canned package. I coded it up. It's not difficult to code. So that's the answer. And I think AmiBroker also has some Monte Carlo in their backtest framework. So that's the first answer. The second question about what you can do more, or if what I have explained is whole, one and sole way, and the answer is it's not. I wish the answer was really black and white, and I did said that earlier as well. The answer is really gray, in the gray area. What I have explained or what I have shown is one way of approaching this problem or analyzing what may happen. We've talked about, if you will go back and listen to the space recording, you'll hear that we've talked about how the straddle returns are more clustered. So the simple Monte Carlo can be enhanced by taking those things into account. You can change it to run on OPEX day, or basically option expiry days separately, option expiry minus 1 day separately, and so on and so forth. So a lot more analysis can be done. This is just the first step, really, what I try to show.
Sure. Thank you, Ankit.
Thank you. All right, we have option geek. If that's your handle, if you want to speak.
Yeah, hi Ankit. Sorry for using an alias, but I have one kind of observation or query for your Monte Carlo simulation or random walk. So I just want to understand, because this is kind of new thing for me, because I've heard about backtests and which are which have some certain formats and which kind of simulate what has happened in the past. But I'm not able to quite fathom what your random walk is trying to do, because as far as I can see, markets are not uniformly random, and even if you say markets are random, they exhibit different randomness on different times, on different time scales. So with this your random walk, you are trying to simulate market in a uniformly random way, which I don't think is a correct way to model a market. If market would have been uniformly random, I don't think anybody in this world would have made money in the long term. Everybody would have lost, because it's kind of, as you say, right? It's just like a coin toss. It's completely uniformly random. So Monte Carlo simulation for me is also uniformly random simulation. So you can't really structure it that way. So for any strategy, let alone this 920, but I don't think any strategy can actually, in the markets, can actually be simulated using a random walk. That's what I believe. What are your thoughts on that?
Right. Very fair point. So markets are not random. They are noisy as fuck, but they're not random. I agree with that completely. And I think I alluded to some of the question that you're asking, some of the points on that. So Monte Carlo has that assumption, like you said, it's the randomization process. It randomizes that. So when we do any kind of statistical analysis or modeling, you come up with some assumptions of your framework. And I think I've been repeating it again and again. This is one way of looking at things, with that assumption that it's random. I'm not saying the markets are random. So let me try and pivot on this. So markets have, if you think about, a very low signal to noise ratio. What that means is there is very, if you look at the returns, if you try to quantify the markets through a process or a model, unlike electrical processes or physics, which has very high signal to noise ratio, markets or financial markets have very low signal to noise ratio. And that's why any model which you fit is, most likely to fit to noise more and less to the real signal. But when you create a strategy, you are kind of doing a filtering on your underlying time series. So you're creating a strategy with an expected profit profile, means you're kind of filtering out the noise and bringing up a higher signal to noise ratio. And thus, when you do a randomization on that, you're kind of defeating that purpose of the backtest. I agree with that completely. And that's why I say this is just the starting point. A more robust way is to slice your data in more meaningful buckets and fashions, and do randomization on that. So, for example, the return profile subjected to or conditional on the volatility environment and day of the week or option expiry day. These two variables, if you condition your backtest on these two variables and do randomization on those buckets, so to say, that will be much more meaningful randomization and Monte Carlo. So you're right, Monte Carlo is just a very initial starting point. And again, my what do you call it? My aim of writing this article was to, the hypothesis that 2x of the maximum drawdown in the historical backtest is a good enough measure. I wanted to test and challenge that, and not really to say and propagate that Monte Carlo is the only and the best way of doing this analysis. It's a start. It's one, for me, in a scale, on a platter of 20 analytics that I might do, this is one of those. So you're right, I agree with you completely.
Yeah, thank you.
Of course, no problem. Arun, can we listen to you now?
Yeah, thanks Ankit for your article and the code. So what I wanted to check, like, have you done any modeling on predicting the stock price and what kind of probability you found there, if any?
So yeah, predicting any model in stock. So stock prediction through modeling is usually a futile exercise. You will, when you create a model and try to fit data to it in your historical analysis, you will come up with a very good model which will fit to exactly what the price is coming up to be. But then when you try and test it out of sample, so in the concept of in sample and out of sample, for those who might have never heard of it, so let's say you have 10 years of data of stock prices, and you want to build a model to say, okay, daily, I want to forecast my daily price on the basis of 10 years of data. I want to build a model. Now, usually a good practice is to divide that data into in sample and out of sample. So what I mean by that is, let's say you divide this data into 70 and 30. So 7 years is your in sample data and 3 years your out of sample data. You build a model which will fit to the 7 years of data. You build a model which will show you less errors and whatever your parameters of regression or whatever machine learning you want to do. You do it on the 7 years of data, and then you then take those parameters and run it for the 3 years, which the model fitting process or regression analysis has not seen. And you will often find that it will quickly deteriorate. And the reason being, like I was saying earlier, there's a very low signal to noise ratio in markets. And when you kind of very naively try and fit a model to stock prices or stock returns, it will fit to a lot of noise and not really to the signal. So in my experience, creating models to predict stock prices or stock returns in a simplistic way is a futile exercise. You really have to club it with a lot more analysis and lot more other techniques or ensembles to really make something useful out of it. And even then, it will be very noisy. It will not be very definite outcome that you can make. I hope that answers your question.
Yeah, so Ankit, what I want to say is, like, we have these all signals like MACD or some 10-day SMA going over that. So can some model be built on that, which again gives a high probability that you should buy, or means whether the stock price will go up or down, means just that increasing the chance, even if not predicting it, like what would be the price?
Yeah, so see, all these indicators are useful in some format, but they're all past looking. They're always, nothing is created
Yeah.
in forward looking basis. And predicting the stock prices and returns is usually very hard. So I'll take an example of trend following. What does trend following do? In a simplistic way, they don't know when the trend will end. They just want to latch on to one which is running, which is already in motion, and you can have cutoffs for your motion, but it is in motion and you want to latch on to that. But it doesn't forecast. It can't forecast. Forecasting models are not easy to build in the financial space, and less so with moving averages and MACDs. These are
hindsight looking indicators which can be used very well to come up with the current state of the market. And maybe if you are sophisticated about it, you can use the current state of the market to feed into a model which can probably, based on the historical analysis, can give you an outcome to say where the next state will be. Like, there's a process called Markov chain process, but I don't want to get into that. And in a simplistic answer is, it's not that easy. These indicators will not really help you. It may help you build trading systems as such. A combination of these trading, like I said, in a simplistic one is trend following. If you are able to use these indicators, say now we are in trend and we want to buy, it can definitely help you, but it will not help you kind of predict where it ends or where should you get out of it. So that answers your question.
Yeah, thanks, Ankit.
Of course. We have Anil Dudhani to speak next. Mr. Anil, can you hear me? Do you want to speak? Not sure. Okay, I'm gonna move to the next speaker, Nitesh Parikh.
Is my speaker on now?
Okay, yeah. Now Mr. Anil is speaking. So Nitesh, if you can hold, please. Mr. Nitesh can speak.
Yes.
Thank
you very much.
It is
very informative.
Mr. Anil can
option,
speak, and Mr. Nitesh can.
You may continue. You may continue.
Can I continue?
Yes, please carry on.
Yes. Thank you very much. I have been listening to this, and it is very informative. And I wanted to ask, what is your suggestion on the Straddle, or you are only talking about the Straddle?
I'm actually agnostic. I'm not really talking about Straddle or Strangle. I just, if you look at the article that I had created and posted on my Twitter timeline, it doesn't matter if it's a Straddle or Strangle. It is just trying to build an analytical framework on taking the returns of your strategy and kind of doing some analysis on it to see what kind of potential drawdowns or it can occur. So we're not trying to discuss which is a better strategy, but we are trying to do slightly analytical analysis on the underlying returns.
All right. Thank you.
Okay, thank you. Nitesh, do you want to speak next? Nitesh?
Hello.
Yes. Hi.
Yeah, Ankit. It's such a nice, informative discussion. It's give lots of to everybody. I just having the confusion about that the dynamics of market. So everybody is talking about the dynamics. Market is very dynamic, and lots of people are creating lots of strategy. Even I have created lots of strategy for myself. So, but the point is that how we are tapping the dynamics of the market, because we are just backtesting the data of last 10 year, 20 year. We are creating the straddles, strangles, and everything. I haven't seen the people who can categorize or classify the nature of market. This is the one of the things which need to be addressed. I may be wrong. Lots of strategies are here.
Yeah, Nitesh, probably the reason is because it's very hard to quantify and categorize the markets looking forward.
This is the problem, Ankit. There are lots of straddle, 920 straddle, 925 straddle, 930 straddle. Lots of people are doing the trying to optimize it. But if it is so wealthy, if it is so to the point, then everybody will try to do it, and everybody will definitely do it. But the point is, whatever kind of strategy we are making and we are trying to deploy in the market, we must be aligned with the nature of the market. This is the point where I think that we are somehow misaligning, and that is the reason that no strategy works very well in the market.
So Nitesh, so there are 2 points I would like to say. Like earlier in the space, hopefully you'll get to hear the recording. I talked about what drives the profit and loss of this 920 strategy. So it's the dynamics of the market itself is dynamic. Now you should also understand markets are evolving. They change. So it's probably not the you created a strategy today based on the dynamics of current market, and markets will change tomorrow, next week, and a month, 2 months, 6 months down the line, and you'll have to adapt to it. So it's not that you can create a strategy which will run forever. That will never happen. No hedge fund global, no big short traders have been able to maintain the same strategy and run it for 10, 20 years because the markets change. So that's the nature of the market, and I think that's the way to approach it. There's nothing wrong with adapting your approach to the new market, when you say they're
Another thing,
optimizations.
Ankit, another thing I want to tell you, I just want to add it that everybody is talking about the algo trading. There is emotionless trading everywhere. The big FIIs, DIs are doing the algo trading. I think that market is somehow know it that algo trading is booming, is flushing in the market. So what I experienced it that if you have some human emotion in the trading, because trading is just a business, if you will involve your human emotion in your trading, you will get the more benefit. I have experienced it because market will
So
hit your
Nitesh,
SL.
sorry to interrupt here. I don't want to get into the interaction of what the algo market is on the emotions, because that's not really the topic. I would like to rather have it focused on the strategy degradation, or the analysis that we can do. So I like to speak to move to the
Sorry,
next
but I
speaker,
haven't
Himanshu. If you,
read your article.
Himanshu, can you speak? I'm not sure if Himanshu can. Himanshu, can you hear us? If you want to speak, otherwise we'll move to the next speaker.
Okay, now I think
Okay,
you'll be
Himanshu.
able to hear me. Okay, so what I wanted to know is, I saw some ARIMA model of linear regression on the time and data series. So, like say that if there is a set of data for not a very 10-year or longer period, but let us say that for monthly futures, this month's data, and if it is encapsulated with the ARIMA model, some points of reversals and the next level can be predicted. So, is it true? It is viable to do so, like where they count the normal rotational count of the instrument. Like I saw one quantitative analysis group, Gunjan Dua and gang, which are from Australia. I saw one of the training program. They said that like for BNF future, the count is 200. So once you see that if it is returning from that point, it would then further go to the mean and then go to the another deviation. That is
So
based on
Himanshu,
linear regression.
yeah, no. So let me try and answer that quickly without taking any names. So first of all, that's not linear regression. That's I've seen the reference that you're making, and that's way away. They are just using the name linear regression and ARIMA, but that's not the case. First of all, second of all, even if anybody who thinks that's the case, it's not too difficult to get free data online, historical Nifty data, and try it out and test it out. That 200-day cycle, and what happens. So what happens is when you look at chart, it's very easy to say, oh yeah, every 200 day it moves. But when you try
No,
and
200
quantify,
point, not
example,
200 days, 200 point.
okay, 200 point.
So it
But
moves
when
in
you,
multiple of 200 points. What
yeah,
they mean to establish is it moves in a multiple of 200 points, Bank Nifty future. Once it has crossed 200, it will touch 400. If it has crossed 400, it might touch 600 and then 800. If it reverses from any point, then it would reverse in the same manner. And this is
sir,
how I think, yeah,
sir,
sorry.
one question. If you think about it, 200 points on Nifty is what percentage of Nifty?
Bank Nifty.
Even on Bank Nifty, it's much smaller percentage, right? 200
Yeah.
points on 35,000 is was 0.1%, less than that, right? So that is expected, right? Agar if you look at that, if you compare that to, let's say, Reliance stock or ITC stock, and you take a 0.1% range of that, utna to move karega hi. So that's that has nothing to do with linear regression or ARIMA. ARIMA is additionally an auto-regressive integrated moving average model. It's a linear regression model, not the way it has been propagated on that website. So I don't want to go into that discussion. If you have question on this analysis that we've done, I'm happy to take it up. Otherwise, I'd like to move to the next speaker.
Okay. Thank you.
All right. Thank you. Arun. Arun, can you hear us? I don't think Arun is able to. We'll wait for Arun. Hitesh, if you want to speak next. Am I audible, Hitesh? Hitesh, can you? Okay. I'm going to move to the next one. Karthik. Karthik, can you hear me? You want to speak?
Hey,
Karthik.
so yeah, can you hear me?
Yeah, Karthik, please.
Yeah, actually, this actually for the last 2 weeks we have a high weeks market. Like, how do we one day like the Nifty was went 5% down. So in that case, like how do we like at least manage the loss and come out? Any adjustment strategies that you
Karthik,
recommend?
sorry to cut you off. So we are not discussing how to manage the strategy of straddle. This space was created to talk about the article that I created about the Monte Carlo simulation and the drawdowns. The manual adjustment. I am first of all completely automated algorithmic trader. I don't have any adjustments in the day and whatever. And again, this is not really the scope of the discussion today. So if you want to maybe read the article and come back with questions, the recording of the space will be available, but the idea is to kind of provide a statistical analytical framework to assess the returns and see what kind of drawdowns it may hit, but not the adjustment. So I'll have to excuse you on that and move to the next speaker. Praveen, if you want to speak again.
Hello. Yeah, Ankit, can you hear me?
Yes, Praveen.
Yeah. So earlier, actually, you answered my query. Now, the second part of it, I would like to get some insights from your side. Regarding this, I had already posted you my comment in the morning in Twitter. Most of the backtesting strategies which are currently being traded by most of the traders, usually we talk about only value drawdown in percentage terms. There is another aspect to it, which is time drawdown. So I would like to understand whether similar simulation can be done in terms of time drawdown, the way you have done for percentage drawdown. If we do it for, say, particular in particular week, suppose we get 3 days time drawdown. In particular year, suppose we get continuously 10 days time drawdown, or say 2 months time drawdown. If we put together and try to understand what is the maximum time drawdown, and similarly if we do Monte Carlo analysis for 10,000 runs, and can we use that to decide when we should stop our strategy, or
So,
can we
Praveen,
do the combination of value drawdown, maximum drawdown, as well as time drawdown? I
yeah,
would like
Praveen.
to
So
get
if you think
yeah.
about it, the simulations, again, go back to the article which is on my Twitter timeline. If somebody has just joined the space, there's an article that I posted, my Medium article from this morning on my Twitter timeline. So the simulations that you have done, which is different 10,000 different paths of of the same strategy, being simulated in the Monte Carlo. all of these strategies, because they are coming up with different drawdowns, they're also coming up with different drawdown days, right? So if you look at that chart again, if you look at that analysis of the one which was only with 4 paths, you will see the time into drawdown and time out of the drawdown in each of those 4 paths, which the initial analysis was, will be different. So what you are saying is essentially already embedded in the analysis, is that information I have not extracted out. And but you are right, we can do a combination of like a joint distribution for somebody who's more sophisticated or wants to do that. But otherwise you can do singular analysis as well. Just like we did the analysis for maximum drawdown or the distribution of the drawdown, you can also do a distribution of the worst time in the drawdown, right? And you can see, okay, in the historical, in my main the first backtest I created, my, let's say, I'm just taking these numbers randomly, okay? Let's say in my initial backtest, I say the drawdown period was 3 months. But when I did the simulation and I draw a distribution of the time drawdown, it may vary all the way from 15 days to 7 months. And you can do the similar kind of cutoffs, the 95 percentiles and all, in that to come up with a in a univariate way or in a singular metric way of the time drawdown. So that's one analysis. What you can also do is a joint analysis or joint distribution, in which you are taking these time drawdowns as one series and you are taking the maximum drawdowns as another series, and then trying to plot a joint distribution of it. So instead of the distribution chart that you see, histogram that you see, which is with 2 axes, it will have a third axis in it, like, so it's a 3D graph in which 2 distributions are being changing, and it's a more complicated one. Now this can be done. Now whether this makes sense, so when we do bivariate analysis or 2 variables, you look at the distributions of them together, you usually want them to be having effect on one and having effect on another. So what I mean by that is, if I ask you a question, do you think the value of the drawdown or the size of drawdown will also impact the days? The answer will most likely for this 920 straddle strategy will be no. I can't definitely say that a value, a level of the drawdown, like say a high level of drawdown, will also mean a high level of time drawdown. So these two variables might not be causation based, or they might be not in a simplistic, or again not the correct way correlated. So whether that analysis makes sense or not is another question. So with data analytics, the thing is, there's a concept called garbage in, garbage out. You feed it garbage, it's going to give out the garbage. So and that's why it's important. I've been stressing on that this is just one step, or the first step of doing this analysis. You have to structure your analysis so that it makes sense. You can do a lot of it with this, but whether it will make sense or not is another question. I hope that answers.
For 920 straddle, whatever you pointed out, I think it is correct. But what I wanted to ask this is about trend following strategies, because what happens is, in trend following strategies, most of the cases value drawdown would be severe, because there might be, especially if we consider positional strategies wherein there could be adverse gaps against you. So it may happen that there would be huge value drawdown in couple of days, but same drawdown would be covered in next couple of days, the way it happened in last week. There was one day 5% gap down, immediately next day it was covered almost 70% of it. So in such cases what happens is, although you are saving maximum time drawdown, maximum value drawdown, it would be covered in just couple of days. So in this particular case, you will have very less time drawdown. But in trend following system, there might be certain period where market would be in very tightly consolidated range, where value drawdown would be very less, but time drawdown could be extended to 3 to 4 months. I guess you
Right.
are getting my point.
Yeah,
So
I
in such
absolutely get it.
cases, the way you have given example of gold and USD chart, so in that case what is happening is value drawdown is pretty less, but time drawdown is considerably stretched. So in such cases also, one has to be very acknowledged about whether that strategy should be executed or stopped, considering only time drawdown. Because although he is not losing much of his money, he is losing his time, right? So we
Absolutely.
have to decide at one point whether that strategy should be executed or not. That
Right,
is
right.
what I wanted to say.
No, absolutely correct. And then again, it's captured some of it in my article that the qualitative analysis. And earlier in the spaces you were there, I remember when we were talking about the PNL attribution of this 920 straddle or even the trend falling. Any strategy that you run, the PNL attribution is very important, and that alone can't help. A quantitative analysis alone can't help. Qualitative analysis alone can't help. It has to be really a combination of the two, depending, because there's so many moving parts, so many moving variables for a given strategy. And for the trend falling, I can also give you example. The 2020 COVID crash was, maybe lasted 3 weeks or 2.5 weeks, and then market was in a steady upturn. But if you go back in history and look at the global financial crisis, or 2008, or even the earlier periods where the drawdowns, or the markets were in a bearish mode, you will see the time drawdown and the value drawdown profile to be very different. So
Right.
it requires, what do you call it, more analysis, but definitely your approach and your thoughts are absolutely correct. I no challenge to that. Thanks.
Thank you.
S Bhatt, if you want to speak next.
Hello.
Hey.
Hello. Can you
Yes.
hear?
Yes.
Actually, my question was I was gone through your this paper regarding this backtesting and the Monte Carlo simulation. My question was very technical. Whether you have any GitHub repository about
Yes.
the process?
Yeah. So if you look at the article at the bottom, I have linked the GitHub code for this.
So it's all done in Python, right?
It's in Python, yeah.
And it is for 248 days, I suppose. Data.
It's for 5 years. No, it's for 5 years. It's for 2017 to 2022 until last week.
Wonderful. It was a wonderful analysis. Thank you for posting it. So rare, nobody posted. Very rarely post their analysis like this. Thank you.
Oh, of course. Thank you. No problem. Hari. I'm sorry. I'm just reading your handle. Do you want to speak next? Harris. Sorry. I'm not sure if they are able to listen to us. I'm gonna. Okay, we've been running this for 2 hours or so. If I have any other questions, people who want to maybe come up, ask questions. Again, to reset the room, this is in reference to an article I posted on my Twitter timeline this morning. It looks at a strategy, which is the 920 popular strategy, 920 straddle, and it tries to analyze whether the simple heuristic of using 2 times your backtest drawdown as a stopping point for your strategy makes sense or not. And it does some statistical analysis, very introductory analysis again. So we've been trying to discuss that. With that said, we have another speaker, Dhaneshwar Suryavanshi. Do you want to speak? Okay, I can't. Not sure if I can. Oh, there you go. Hello. Okay, they're on mute again. We have Amrut coming up. If they are able, still stay connected. Okay. I'm going to remove one speaker. Okay. Amrut is still coming up. Okay. I think we are running out of questions from people. Again, we'll probably keep this line open for 5 more minutes for if anybody wants to come up, have a question that they want to be answered. Again, I can stay on for a few more minutes. The article is on my timeline from this morning, or my Twitter feed, if you want to call it. Mr. Suryavanshi, are you able to speak now? No. Oh, I don't think so. Okay. Right. I'm gonna wait out for 30 more seconds maybe 60 more seconds. I've covered the article. Again, it's on my timeline. It's a Medium article. The recording of this spaces, I'll definitely be able to post on Twitter. With that said, for 30 more seconds, 60 more seconds, if we don't have any questions, I'm gonna end this space. Sorry about not being able to integrate this with YouTube. I was doing this space for the first time. I've had quite a few webinars in the past for video screen shares. So they worked fine. For some reason, this one did not. But I'll try and maybe create a short synopsis video for this and post it on YouTube for anybody who might be listening to this later on and might want to see the code or maybe have a code walkthrough if they want to. But for now, I'll likely be. Hey, Amrut.
Oh, hello, but I'm not able to hear you, but I can read your captions. Some problem in my mobile. I just wanted.
Okay, please go ahead.
Yeah, I wanted to know like in 2017, the drawdowns of any strategies, let it be BTP 920 straddle or 940, 950 straddle. It was just around 4 to 5K per lot, and it has been increasing drastically year on year. Like if we consider that point of time, it has been 4K to 8K, 12K. Now it has been around 25K, for example, 920 strategy. So like at one point of time from 4K, it has been doubled, tripled 4 times, and we can't just decide we can just stop the strategy at when the drawdown has been doubled. And is the increase in the premiums that has been occurred from 2017 to 2021 has it been any effect on this? And should we reduce our position size when the premiums gets increased due to maybe underlying price increase or volatility increase? What do you have the thoughts on this?
Yeah. So thanks for that question. We did discuss some of this earlier in the space, but let me try and reiterate what I said. So the option premiums are a function of the underlying price. So in 2017, your Nifty was 12,000 or whatever that level was.
Yeah.
Now it is close to 16 to 17. So the in terms of 1% move, if you talk about it back then, must have been 120 points, and then now it is 170 points. So by the fact that the base of your underlying has moved up, your premiums will also move up in the same fashion. So that's why even if the volatility remains the same, or even if the implied volatility that the market is expecting to realize in future remains the same, your option premiums will change with respect to the underlying index. Okay.
That's okay.
Now, having said that, I don't think it's fair to look at absolute PNL over the time, because it will always happen. Like if you run a 10-year back test, 10 years ago 1,000 rupees profit and today 1,000 rupees profit is not the same, unless you normalize it to either index levels or to the capital that you've been trading. So my analysis that I used, it's all percentages, because percentages are comparable. 10% 10 years ago and 10% today is comparable, but 10,000 rupees 10 years ago and 10,000 rupees today is not.
Yeah.
So if you want to do that analysis, I would suggest you normalize it to either index level or to your capital base, and that will help you get some more perspective.
Yeah.
Now, whether that means the strategy has been deteriorating, maybe not. And when I drew that Monte Carlo analysis on the article, since I was using percentages, actually, if you look at my GitHub notebook, it has a scatter plot which shows that the returns, percentage returns have also widened. Like it has gone both ways, positive and negative. And that is a function of the underlying volatility of the market in the last 2 years. So a lot of things change, and that's why we kind of trying to draw these tools, use these tools to make sense of what has changed, right? But yeah, with volatility or expected volatility, your premiums will also change. Whether that changes or whether that impacts your, or how it impacts your strategy performance, we've discussed that earlier in the space today. So if
Yeah,
you
yeah.
go back to and listen to that recording, anybody else who might have later joined, if they go back and listen to that recording, you might be probably able to get that kind of answer or a comment.
Fine, fine.
All right, thank you. Okay, I think I'm gonna end this. I don't have any other speakers. Maybe 5-15 more seconds. I think we've run out of time. We've covered the agenda. Anybody who I've been getting a lot of questions. They were on the article that I posted on my tweet, and there have been so many sub tweets and threads. People have discussed a lot of approaches. A lot of it has been centered around 920 straddle. I kind of picked that up because that's a strategy that everybody understands and can discuss at length. But this kind of analysis can be done for any form of strategy. And again, I can't insist this enough. This is just first step of the kind of analysis that you want to do. It's the realm is way wider and way deeper on that. Okay, so I'm just gonna wait 10-15 more seconds and then we'll just probably end it out. So thanks everybody who joined, listened in. I hope you derived some value and help out of it. My DMs are always open if you want. If you have any questions or follow-ups on the article, I'm happy to answer. Please don't message me saying how to do adjustments or what is the best strategy to trade. I'm sorry, I'll not be able to answer those questions. But if you want to challenge my analysis or provide some alternate views or get some clarity replicating some of the code, or if you need data on the strategy, I'll be more than happy to provide that. Okay, with that said, thank you everybody. I'm going to just end it. Thank you.